Welcome back. Today we're digging into ChargePoint's latest earnings, and wow, it is a classic Wall Street head scratcher. You've got a company reporting some really huge internal progress, but the stock? It got absolutely punished. So let's break down why that happened. Okay, so this slide really lays out the two completely different stories we're dealing with. On one side, you've got management, and they're celebrating these big operational wins. We're talking record margins, fantastic cash control. But then you look at the other side, and the market's reaction? The stock drops more than 5% after hours. So you have to ask, right? What on earth did investors see that just completely overshadowed all of this good news? All right, to get to the bottom of this, here's what we're going to cover. We'll hit the Q2 financials, break down the bull and bear cases, look at their big bet with Eaton, and then wrap it all up with the investor's dilemma. Okay, first up, the Q2 financial snapshot. Let's just run through the key numbers real quick. So, revenue. It came in at $98.6 million. And hey, that's a solid beat against what Wall Street was expecting. But, and this is a big but, it was still down 9% from a year ago. That's kind of our first clue about the bigger market slowdown we're going to get into in a bit. All right, so the top line was a beat, but the bottom line, that was a miss. Their adjusted loss per share was $1.42. Analysts were only expecting a loss of about $1.16. So that tells you that, yeah, cost pressures are definitely still a thing for them. But check this out. This is a major bright spot, and it's something management was really hammering home. Non-GAAP gross margin hit a record 33%. In simple terms, this means the company is getting way more profitable on every single charger they sell. That's a huge deal. Now let's dig into where that money is coming from. And what's really interesting here is the growing power of subscriptions. That piece of the pie grew 10% year over year and now makes up a full 40% of the business. You know, for an investor, that's exactly what you want to see. It points to a much more stable, predictable business model. Okay, so that leads us right into the bull case. Let's look at the story management was trying to tell, a story all about strong execution, basically ignoring all the noise from the outside world. And their CEO, Rick Wilmer, was really all about this theme of operational excellence. This quote here nails it. It's confident, it's focused on what they can control, and, well, they controlled it really well. And look, this focus on profitability, it's not just talk. This chart says it all. This is the 7th straight quarter of margin improvement. That's not a fluke. That is a powerful trend. It shows real, consistent discipline. And the cash story? Honestly, it's just as impressive. They cut their cash burn to under $2 million. I mean, let's put that in perspective for a second. Last quarter, it was $29 million. A year ago, $49 million. To go from that to under $2 million, that is a massive, massive turnaround. So the bull case really boils down to this, right? The company is building a much, much more solid financial foundation. They've got cash, they can get more if they need it, that sweet subscription revenue is growing, and they don't have any big debt payments coming up anytime soon. It's a pretty strong picture internally. Okay, so if everything was so great on the inside, what did the market hate so much? Well, that brings us to the bear case, those big, powerful challenges happening outside the company's four walls. And here it is. The single biggest red flag for investors was the guidance. Management said they expect revenue next quarter to be around $95 million. The problem? Wall Street was looking for something closer to $108 million. That is a huge miss, and the market does not like surprises like that. And to make things worse, they also pushed back their timeline for hitting profitability. You know, the point where their core business actually starts making money. Now, management tried to spin this as a strategic choice to invest in innovation, but for a market that is absolutely starving for profits right now, any kind of delay is a really bad sign. And just look at how badly the stock has been hammered. This is stark. It's not just, oh, the whole EV sector is down. No. The main EV ETF was down, 3% for the year? ChargePoint is down 67%. This is a company-specific problem in the eyes of the market. So why is this happening? It's really a perfect storm of headwinds. You've got slowing EV sales growth, you've got a ton of uncertainty around key tax credits for charger installations. That big federal NEVI program, it's rolling out way slower than anyone hoped. And on top of all that, their big customers are getting nervous about the economy and delaying projects. It's a tough environment out there. So what's their plan? How do they fight back against all these external pressures? Well,
It all comes down to their big bet on innovation, and specifically their partnership with the industrial giant Eaton.
They've worked together on a new DC fast charging setup that management is basically calling a game changer. And the promise is pretty simple. It's about 30% cheaper to install, it takes up about 30% less space, and it's about 30% cheaper to operate. For the people who own these charging sites, that's a massive deal. And a really key piece of this new tech is something called vehicle to grid, or V2G. Basically, it lets EVs send power back to the grid when it's needed most. Now, this isn't just some cool, futuristic feature. It actually creates a whole new way for charger owners to make money, and it's a huge deal for utility companies trying to keep the grid stable. All right, so this all brings us to the final takeaway, to the core dilemma for any investor looking at ChargePoint right now. It is a classic battle. Great execution today versus a whole lot of uncertainty tomorrow. So here we are, with two completely opposite stories. The bull case says, look, this company is executing brilliantly on everything it can control. Margins are at a record high, they've stopped burning cash, and they're innovating. But the bear case just says, none of that matters. Not when you've got weak guidance and these massive economic headwinds slowing down the whole industry. Which leaves us with the one big question. Is ChargePoint's innovation strong enough to outrun these market headwinds? So for the next call, here's our take. We absolutely expect to see them keep improving margins and managing their cash well. But that weak guidance tells us the revenue story is going to stay under pressure. The internal turnaround is real, it's impressive, and that keeps us from being outright bearish on the stock. But those external factors, they're just too strong to ignore right now. And for that reason, our rating is market perform. You've got a company that's doing a fantastic job fixing its own ship, but it's sailing straight into a Category 5 storm. And as always, just a reminder, this is not financial advice.